Good morning, everyone. Good morning. It is June 30th, 2025. It is so good to see you all this beautiful and amazing Monday morning here in Austin, Texas. Excited to gather with you all this Monday morning. Lots going on in the market. And I love the fact that our Monday touch point is the last day of the month because we're actually going to be able to compare month over month trends. Very hard to compare month over month trends when you're doing this update towards the beginning or the middle of the month. But the fact that today is the very last day of the month means that we're going to have some really good comparison data that we can review. And the first thing that I want to do, the first thing that I want to update you all is going to be on the Freddie Mac Home Price Index, because that was released this morning at 6 a.m. this morning. That was published, that was released. That's where they track over 200 cities across the entire nation. And then they focus on the top 40 cities based on population. And that information was just updated this morning. Let's go ahead and take a look at it. Very important for us to understand where Austin stacks against the other top cities in the nation. And of course, you can find that on Insight and Statistics. You scroll down, you go to macroeconomic data, and this is where you can find the house price index. This is published by Freddie Mac, and what I like about this home price index, very reliable, very historical, goes all the way back to the 1970s. And what it does, it looks at like homes over a period of time. Really reliable. I mean, anyone that would ever read their methodology would say, yeah, that's reliable. It's stood the test of time. And as you can see, this was updated first thing this morning. Let's go ahead and take a look at it. Let me make this just a little bit bigger for you. As a matter of fact, I'm going to go ahead and download it so that I can cover the entire screen so that you can see the entire thing. Let me adjust this. And let us see where Austin is compared to the top 40 cities. And then also, how are we compared with the 260 plus cities that they track? I've got a few different columns right here that compare that one. You've got the metro area. Oh, let me go ahead and just get this back over here. Just give me 1 second. Where did it go? Okay, perfect. You've got the metro area. Then you've got the peak month, meaning if you see May 2025, it means that market has reached its peak in May. This is a lagging indicator, very reliable, but also backwards in time by up to 90 days. Because here we are, June 30th, getting pricing data for May. That's the average price over the past 3 months. So it's going to be February, March, April, May. So the data that is published June 30th is the average sold price for March, April, and May, published in May. So you see how that can be a very laggy indicator. And if a property sold in March, you're capturing 30 to 45 days before that even. You're capturing the sentiment of the buyer back in February. So here we are, June, looking at buyer sentiment for January, February, March on data that was published March, April, May, summarized, and then made available today, June 30th. So I love this index. It stood the test of time, accurate, historical, really good, and yet it does not tell us what's happening today, June 30th in Austin, Texas. That's why we have our own criteria. That's why we have our own measurements, the activity index, the new listing to pending ratio. These will tell us what's happening right now. I don't care what the average temperature was back in February, March, April, and you tell me in June because you pull the data in May. Could care less. I want to know what the temperature's like today. Important to know historical, but I want to know right now. So you've got the metro area, you've got your peak month, and you've got your drop from peak. Then you've got the adjustment it's going to be up across the board. But from January of 2020, from January 2021, from May 2020, year over year and month over month. And here we've got Austin. Of course, we all know this. We've been going over this for months and years. Our market has peaked back in May 2022. According to Freddie Mac, we've had a 15% adjustment in value from our peak. We are up 41.2% from January 2020. We're up 18.7% since January 2021. We are down. We peaked in May, so we just happen to be comparing May to May. I always do a 3-year comparison. We are down 15%. That matches our from peak. But we are down 5.4% year over year, and we're down 2.8% month over month. So let's take a look at a few other cities. Melanie said I spoke with a Florida agent yesterday, and their market sounds like it's following ours, which we already knew. No doubt about that. No doubt. And yet, you've got a few markets. I was just in Boston yesterday, didn't land until like 1 a.m. last night and ended up getting to the house at 2 a.m. But I was in Boston yesterday, and y'all, Boston is as hot, if not hotter, than Austin was back in February, March, April of 2021, 22. Remember the insanity? That is Boston right now. You cannot find anything for sale, and the prices are just beyond what you can imagine. You go to a quote unquote working class neighborhood in Boston, and you're not finding anything for less than $1.6 million. It just doesn't exist. You can find a teardown for $1 million. Insane market. And you can see that the Boston market is up 53%, 53.6. But look at year over year. It's up 12.4% year over year. Month over month, it's up 4.2%. So you do have some markets, primarily in the Midwest, Northeast, that are on fire. Just amazing. You just cannot even find anything, whatever you want. You've got to go way overpriced. It's incredible. I'd like to know which other markets are starting to come down like Austin. Well, yeah, that's what this tells us. That we've got graphs and we've got the resources that show us exactly which markets now are correcting markets, also based on their inventory levels. You've got Dallas. Dallas is down 1.6, Denver 2.1, Houston 1.9, Jacksonville. You see the trend. The southern states are just getting killed. You've got Orlando 1.1, Phoenix 1.3, Portland, northwest. You've got Riverside down only 0.04. San Antonio down 4% from peak. San Francisco 4.1. So let's take a look at some graphs. So here is the comparison. Here you've got Austin compared to the top 40 other cities. The second worst city in the entire list is going to be San Francisco with a 4.1 drop from peak. We are at 15%, way outpacing any other market. Then you've got San Antonio now at 4% drop from peak. And you've got Dallas at 1.6% drop from peak. Let's keep on going. Take a look at from January 2020, we are still up 41.2%. But remember back in May of 2022, we were number one on the list. And now the number one city is going to be Miami with a mind-blowing 76.2% increase. This is going back to January of 2020, so that pre-COVID. Just amazing. From January 2021, the average appreciation across the top 40 markets, 38.4%. We are at 18.7%. San Francisco is going to beat us at 14.5%. That's going to be the worst performing city going back to January 2021. But when you go back to May 2022, that's where we do our 3-year analysis, our 36-month analysis. There you've got Austin. You only have 7. Only 7 out of the top 40 cities have gone down in price, going all the way back to May 2022. Of course, Austin being the first one. And you've got we got San Antonio right there at 3.7. But look at Houston, 2.8. That's going to go negative. Look at Dallas, only 1.1. That's going to go negative. And let's take a look at the year-over-year price change. The average year-over-year across the nation is a gain of 7.6%. That's a gain. Year-over-year. You take the top 40 municipalities population-wise in the entire country, and they experience an average gain of 7.6%. That is amazing. We remember those days, 2021, 2022, but now year over year, we unfortunately are the least performing city, the worst performing city, and the only 2 cities in the entire country. When you look at the top 40 cities that experienced a deflation, Texas, Austin, and San Antonio. Let's take a look at the month over month. Thankfully, Austin is not number 1 month over month. That is reserved for the city of Tampa, down 3.63%. You've got San Antonio down 3.45. You've got Austin at 2.77. But a lot of Texas cities. So there's that southern, apart from San Francisco, you've got that southern region that is just dragging the market down. It's the worst performing region in the entire country. We now have more new construction properties on the market in the southern region of the United States than at the peak of the last Great Recession. So whoever says there's no inventory, it's outrageous. There's plenty of inventory. Let's take a look at a few more, and then I'm going to answer some of the questions right here. But one thing that we have to keep in mind is this is going to be, for our area, the month-over-month percentage difference. And you take a look at May. In month-over-month, for May, it was the worst performing month-over-month going all the way back to 1988. Half of our team didn't exist, like as human beings, back in 1988. So we just experienced, according to Freddie Mac, the worst month-over-month performance for the month of May, because we had some worst ones here recently, but it was the worst May on record going all the way back to 1988. What does this tell us? Well, it's not really slowing down. It's actually accelerating. And we've noticed that on our internal stats. And I believe that June and July is going to provide way more pressure on the market. We've got sky high inventory. We're going to talk about that. Year over year, we're down 2.8%. That is worse than last year. And that is going to be the highest year over year drop going all the way back to the month of October. So we noticed some improvement. We were at 2.9, 2.5, 2.0, 1.6, and then it starts creeping up. You see that trend? It goes down and then it starts creeping up. And that's what we're noticing, a reversal of fortune. Take a look at the Austin market. And this right here answers the question that was posed here earlier over chat. Why is Austin a trendsetter again? Well, it was a number 1 bubble in the country. Bottom line, look at this. This is insane. Look at this graph. This is a year-over-year percentage difference going all the way back to 1975. The only other period in Austin real estate history where we had anything close to what we saw in 2021-22 was back in 1983. In October of 1983, we reached a year-over-year peak of 31.31%. We beat that September 2021 at 33.24%. But we have to go all the way back to 1983 and realize it dropped then 15.23%. And how similar are these two trends? Very similar. The big question right now is what happens here moving forward? Do we then have another reversal? Do we slowly keep on going up? I do not believe that we're going to cross this line because this 10.17% year over year is comparing the price based on 1 year prior. So you had a massive drop, 10.217%. Well, now the prices are lower. Now the prices are 15% lower. So you could have a $10,000 drop that is still significant on the market, still keeps prices low, but it's not going to be as high of a percentage in relation to this previous percentage. So I do believe that we saw our big drop, and right now it's just a series of small corrections that keep on happening. You do 4 steps forward, 10 steps back, 5 steps forward, 2 steps back, and it keeps on going back and forth. So why were we the trendsetters? Because we were the number one appreciating market. We also are experiencing reverse migration. People that moved here back in 2021, 22 into 23, we had a significant portion of people leave. They left. Travis County, for the first time in decades, experienced a decrease in population. And that's at the very same time where all of the housing became available because all of the demographers looking at COVID and looking at the COVID transplant said, wow, this is amazing. Austin is experiencing this incredible population boom. All these companies are moving to Austin. They're making Austin their headquarters. Let's just build. Massive developments. But from the time they request a permit and they develop the land to where they go vertical, it's 24 to 36 months. Now we have an abundance of housing, not only on multifamily, but also home ownership. At the very same time, the people that moved here back in 2021, 22, they're like, I'm out of here. I'm kind of going back home. That's what's going on. And of course, you add multiple layers to that. You've got interest rates. You've got inflation over the past few years that just kill the consumer. You've got a high tax rate. So all of those items combined, it's just caused demand just to absolutely plummet. So that's the reality. That's what's going on. And we're just going to have to ride it out. I am convinced that because we dropped by the fastest, that we will reach a affordable level where Austin will be attractive again for real estate. I would say that it's going to take another 18 to 20 months. It's still overpriced. We will still see further pressure on pricing, especially when you look at the new inventory hitting the market. But every day that goes by where prices go down a little bit more, it makes Austin more attractive. That's what's going on. So I hope I was able to answer your question. But that right there is my analysis on Austin. Out of the 384 cities, I believe I said 260 earlier. That is incorrect. Out of the 384 cities that Fannie Mae tracks, 106 or 28% are down from peak. If we remove the population marker, it would be the first set of graphs were the top 40 cities based on population. This is everything, all 384. We're still number one. Punta Gorda, Florida, that comes in number 2 at 13.3%. You've got Cape Coral, Fort Myers, that comes in at 11.9%. Pueblo, Colorado, 6.1%. A lot of cities, but take a look at Killeen. Killeen is not a part of the Austin MSA. That right there is down 4.4%. The Villages. I've got family that lives in the Villages. You know what the nickname for the Villages is? I'll tell you right now. God's Waiting Room. That's the nickname for the Villages. Beautiful place. Beautiful, beautiful, beautiful place. I'm not trying to mock the Villages. I'm just reporting facts. So you've got a lot of pressure right here within the southern states. You can get this list. So where do we stand? You've got 23 metro areas that reached their peak May of 2022. You've got 7 June 2022. Look at the gap. We've got 23 May, 7 June, 2 July. Not a single city reached their peak from August 2022. Then you've got August 2023, 2 cities. Then you've got a big little bump right there, May 2024, June, July. You've got 31 cities reach their peak May 2024, more so than May 2022. But we still have 278 cities that are now at peak level. So this was just released today, this morning. You can find this by going to Insight and Statistics. You can go to the Freddie Mac House Price Index. The article is updated. You can add your personal subdomain to this. You can use it for articles. You can use it for whatever you want. The FAQ is updated. Everything is updated. We went ahead and just did all of this morning. Let's go ahead and just start updating the new listing to pending ratio, the single best leading market indicator available for the entire area. This is going to give us that pulse of the market today. What is happening with the market today? First thing we're going to do is we're going to go backwards in time a little bit. We're going to go from the 16th to the 23rd. We're going to be focusing, as always, in the 6-county area. That's going to be Travis, Williamson, Bastrop, Hayes, Caldwell, and Burnett. And we're going to be able to update this pending from 349 to 397. That's going to give us that 0.60 new listing to pending ratio. This is going to go to 469. We're going to go from the 2nd to the 9th. That's going to be 485. We're going to keep on going until I no longer have to update anything. This is going to be 557. 19 through the 26, 530. Let me just go a few more weeks right here. We've got 584. This is updated, 584. And last one is going to be 5th through the 12th. That's going to be 561. And I'll update the rest later on. I'm just going to do one more week right here. This is going to be 640. Wow, a lot of late data updates right here. First thing we're going to do is take a look at the open house. How many open houses were offered over the past 7 days from the 23rd all the way to the 30th? Unlock MLS, and we're at 3,435, 3435. Now we can start updating the number of new listings that have come on the market from the 22nd to the 23rd. Also in the 6-county area, and we're at 1144, 1,144 new listings. Last week, 1,223. I don't know that we're going to beat the record from last week, that 1,223, not really a record, but beat that number, because a lot of people are going to wait until July 1st to list instead of just listing today. The very last day of the month tends to see a little bit of a drop. If you're averaging 75 listings every single day, the very last day of the month tends to be about a 30% drop because people would just rather list it at the first day of the month. So I do not foresee us beating that 1,223. I'd say we're going to get very close. We're going to cross 1,200 into the 1,205 or so. On the price increase side of things, only 140 price increases. On the price decrease side of things, we're at 2,409. Not bad. I mean, 95% of the price distribution was a price drop. But 2,409 isn't that bad. But that 95% is really telling, because that right there is going to be the single largest percentage going all the way back to May 20th to May 27th of 2024. So we are seeing more and more price drops. And let's take a look at back on the market. We're at 223 back on the market. That number is now lower than the week before, meaning sellers are giving more concessions than the week before. Active under contract at 419. And this is where you get to guess. I need 5 guesses on how many pendings over the past 7 days. Keep in mind that whenever we pull this information, first part of Monday. It's going to be a little bit on the lower side of things. We're not going to be like 397, but let's go ahead and get 5 guesses. You know the drill. I always do 5 guesses before I click on that number and get the data. We've got Harold kicking us off at 215. Thank you, Harold, for boldly kicking us off. We've got Jason coming in at 221, slightly bearish or bullish on that side of things. Let's keep on going. Keep on going. We've got 237, Jen. We've got 174, Jeff. Very, very bearish on the number of pending properties. Do we have 5? We've got 1, 2, 3. Okay, we've got Melanie Price coming in at 199. I believe we're very close to 5. Let's go ahead and just click on this number. We are at, I can celebrate a little bit. 235, still starting the week at a 0.48 ratio, meaning that we're going to end as we continue updating this number over the next few weeks. We're still going to end right at that 0.6 to 0.65. That puts us at that kind of substantial / tangible plus increase in inventory. Inventory will continue to go up. We do expect a drop in inventory from today to tomorrow. Why? Because of withdrawns and expireds, more so expireds, especially it being on June 30th. A lot of listing agreements went to June 30th. So we are going to notice a drop in months of inventory tomorrow. We're going to notice an increase in activity index because we've got less active properties to divide by the pending properties. So between today and tomorrow, inventory is going to go down. Activity index is going to go up. There's like this illusion that things are like, oh, wow, things are improving. Well, it's not. Activity index is, I only care if the activity index goes up if the pendings are going up. If the pendings are going down, but the number of active listings are down even more because of rejects, because of expireds and withdrawns, then it's a fake improvement in the activity index. That's why we break down all the data to see where is this improvement actually coming from. But you can expect an improvement in inventory between today and tomorrow, being today is the very last day of the month. Let's take a look at some comparisons. So we're down year over year on same week, year over year. We're down 24 on the number of new listings, meaning we're going to beat last year. 2 weeks ago, we were up 17. 3 weeks ago, we were up 33. 4 weeks ago, we're up 127. But we are going to be, between now, 10:29 a.m. to 11:59 p.m. tonight, we're absolutely going to get 24 additional listings hit the market. That's a guarantee. We're down 72 on price increase. We're up 210 on price drop. We've been up on price drops going all the way back to January of 2025. This entire year, we have had way more price drops than we've had the year before. Back on the market, we're down 19. That also contributes to sellers' willingness to negotiate more. We are down 137 on active under contract, down 283. But I do want to focus here over the past few weeks on the pending side of things because this information is 99% updated and accurate. So let's take a look at from June 16th to June 23rd. Down 74 on active under contract, down 130 on pending. Up on new listings. So we've got more properties entering the market, less properties being absorbed by the market. What does that mean? Increase in inventory. And you can see the ratio. Last year, 2 weeks ago, the ratio was 0.74. This year, 0.60. So far, the ratio is 0.48. Last year, it was 0.76. We're going to end at about 0.60, 0.62. It's going to match the past 3 weeks. That's where we are. It's just a very stagnant market right now. Buyers are out there. Don't get me wrong, y'all. There's plenty of business to be doing out there. You can have your record year in real estate regardless of any market. We have to understand the market so that we can equip our clients, position our clients to take advantage of the market, whether you're a buyer or the seller. But there are many clients out there, right? There are 4,500 properties under contract. You mean to tell me you can't get your unfair share of those people looking for homes? plenty of deals out there for you. You just have to be a lion in the Serengeti, not a lion in the zoo. The food's not gonna be thrown at you. You're just gonna have to go and just wake up and hunt. That's just the reality, which is exciting. That's one of the things I love about real estate. But you've got to hunt a little bit harder this year. That's the reality. It's just not as many gazelles out there in the pasture. So you just have to hunt just a little bit harder, but you've got to get your unfair share. Let's go take a look at the entire month of June. Let me delete the previous data from June. We currently have in the 6-county area 16,458 active homes currently on the market, a massive increase compared to last year at 14,217. First thing I'm going to do is go backwards in time a little bit on the pending, make sure that we update. This is going to go from 2044 to 2054. Let's take a look at April. This is going to be 2118. That's perfect. Let's start updating all the other data points. So far this month, number of new listings. 4682. Wow. 4540 was June of 2024. We just beat that. We just crushed that. 4682. Let's take a look at price increases. We are at 576. Price decreases. We are at Ooh-wee. Wow. It's hard to believe these numbers. 8,956 price drops this month. 94%, matching July of 2024, 94%, which is a huge number. Let's take a look at back on the market. 853. 18%. Well, that number went up. That's interesting. Wasn't expecting that number to go up. Why did that go up? We do usually see back on the markets go. We saw that right here last year. That went up from 16 to 19. But the market improved last year. Whereas here, you've got a decrease in performance with an improvement back on the market. Could be financing. Active under contract, we've got 1920. Oh. Are we going to beat last year? Last year was 1982. Can we get 62 properties active under contract today to close out and be better than last year? I hope so. And we've got pending. 1429. Okay, so we've got a 0.61 ratio. When the agents update all the pendings, it's going to bump that up to about 0.64. We're going to beat last month, May, at 0.62. It's going to end up being very similar to April at 0.64. So even though I'll take every win, I don't care. I'll take the smallest win in the world and I'll find joy in it. But bottom line, you all, you know this. We've been doing this forever. We've been doing this since January of 2000. Only two things have never let me down: the good Lord and the new listing to pending ratio. We know that when it's around that 0.6 to 0.65, we know that there's a lot of pressure in the market, a lot of listings stay in the market, lack of absorption, lack of demand in relation to the new listings entering the market. The reason why we rely so much on the new listing to pending ratio is because the ratio is in direct proportion to the number of new listings. So if new listings drop, but the demand drops even more, it's expressed in the ratio. That's why it's tried and true. That's why it's trusted. That's why I rely on it. And this means that even though, because this is what happens between now and March, we're going to hit peak active listings, meaning the number of active listings. Take a look at last year. We reached peak active listings June of 2024 at 14,217, and then it plummeted down to 10,533. And what do the what do the people that spin news, what do they do with this data? Oh wow, active listings went from 14,000 to 10,000. What's the spin? What's the natural spin? If I were to tell someone, man, inventory's down 40% in 6 months, what does that lead? What could that convince you? Let's get some brainstorming here going so we understand the reality of the market. Hey, hot market. But if I correlate this with a ratio and I'm like, whoa, wait a second here. Okay, we've got the 0.75. I mean, these are decent ratios, but not nearly a ratio that would express a crazy hot market. And in December, we had a worse ratio than a year ago. Well, now I'm like, well, no. Why is it that listings are going down? And then I look at the expireds and withdrawns, and then I can say, okay, we've had 15,458 expireds and withdrawns. How does that compare before? Oh, that's 2,000 more expireds and withdrawns compared to the previous year. So the inventory is not improving because on the demand side of the equation, it's improving because of the give up side of the equation. So that does not communicate a healthy market, but that ratio is going to tell me that. That ratio is going to clear out the noise. And if it's a 1.1 ratio, it's a hot market. If it's a 0.75 to 1, it's going to be that balanced market. If it's a 0.6 to 0.7, that's going to be that substantial increase in inventory. If it's going to be from a 0.5 to a 0.6, or a tangible increase, that's going to be a substantial increase. If it's under a 0.5, forget about it. The market's crashed. There's no demand. It doesn't matter. Nothing matters. Under 0.5, it's a crash market. It always tells us that. We always can trust it no matter what we think and what we feel. Withdrawns, we've already had on the withdrawn side of things, or I'll take a look at sold here shortly, but let's do withdrawn 973. Wow. I mean, classic example. Last year, for the entire month of June, we've had 770 withdrawns. Now we've got 973. And let's take a look at expired. We're at 316. I'd say we're going to see a lot of expired this month. We're going to beat that 466. No doubt about that. Now, let me pull up some sold data. Sold data is going to come from a different screen, so I need to log in and search a completely different screen. On the sold side of things, we're looking at 2406. Let me update last month to see if agents updated anything. This is going to be 3087, a slight update. Agents are so bad with updating information. 2623. And let's go from the 1st to the 31st, 2629. Okay, that's all perfect. So that's all good. Let's take a look at residential year over year. Active listings were up 15.8%. New were up 3.1%. Price increase, we're down 83. Price drop, we've got 1,409 more price drops. Back on the market, we're up by 7. Active under contract, we're down by 62. Pending, we're down by 433. That's going to be a 12.8% drop year over year on pending. That's going to shrink. It's going to be single digit. It's going to settle somewhere around the 3 to 4%. Sold, we're down 15.4. That's going to be it's going to be cut by half, around 7.5% drop on the number of sold properties. Let me go ahead and just save this really quick. Let me move my screen. And what I'll do is I will save it. And then we can take a look at some of the charts, take a look at some inventory, active listings. Let's take a look at some graphs. So I've got to save it. I've got to upload it to a different drive system. Got to turn around, actually grab a completely different computer and open up this information and print it out really quick. So just give me 1 second so I can just get this entire resource converted to PDF, and we can actually take a look at some charts, and we'll look at inventory and see what else is going on with the entire market. Oh, here's the... Okay, so here we go. We've got... Okay, great. It's exporting, and I'll just copy it to a separate screen that I can actually show you all. In the meantime, let's take a look at the number of active listings. Oh, it was done. It was done way faster than I was expecting. So let's pull this up. Let's pull this bad boy up so y'all can see it. Okay, good. After this copies, it's only going to take another 5 seconds or so for this to copy. You are going to be able to go down here, click on new listing to pending ratio, and let's see if it's updated. Let me do another refresh, and we will make sure that, oh, perfect. There you go. It's updated. So now it's live on the website, fully updated. Everything that we did is updated. You can just get all of this information. If you need to review this with a client or whatnot, it's now available for you to use the latest and greatest. But let's take a look at some graphs really quick, especially on the monthly side of things. We've got the difference between new and pending, 2186. Last year it was 1582. And there's a ratio. Wow, we've been just going down since February. Very similar to last year, but we started going back up June and July, but we've been going down again in June. And the increase last year was way more pronounced, 0.67, 0.71. We are going to see a little bit of an increase. I'd say we're going to settle around the 0.64 off based on last year. Here's the new listing to pending ratio. Y'all, I mean, we're very close to COVID level on the ratio, which is really somewhat shocking at a 0.61 ratio. Here's that 0.61. I mean, we're at 0.58 June of 2022. So this goes to show on how weak the demand is right now for Austin real estate, down 15.2% on the ratio. Number of active listings were up 2.2% month over month. We're up 13.6% year over year. And take a look at the number of active listings in comparison to the historical average. We're up 54.7% based on the historical average. When you look at the active per 100,000 people, we are now 18.1% above average. So we have to go all the way back now to 2010. Active listings per 100,000 people compares apples to apples. New listings. Let me show you the cumulative. Oh, wow. Take a look at this. Cumulative new listings from January to June, almost 30,000. 29,668. That's already, we still have 11 hours and 16 minutes left in the day. Or 11 hours and 16 minutes, 13 hours and 16 minutes. Still have 13 hours in the day, and we are already 7.6% year over year, and we are 31.6% above average. New listings per 100,000 people. Thankfully, we're down. We're below average when you adjust it for population. That's a good thing. But when you do the cumulative, when you add January, February, March, April, May, June, we are slightly below average, 5.1, but we are at the highest we've been since 2010. I'm going to skip back on the market, focus on pending, because this is the eye-opener. When you look at the cumulative pending, we're at 22,000. We're at 30,000 cumulative new, 22,600 cumulative pending. Do you see the disparity, the disconnect? That is what's causing the challenge, and that means that the difference, this is the cumulative difference between new and pending. You've got the new listings by this teal looking color. You've got the pending listings with this yellowish, dark yellow, and you got the difference. The cumulative difference between new and pending so far this year, 7,042. That's the cumulative pending difference. Active minus pending, we're at 13,109. And that's just an absolute record high. Doesn't matter how far back you go. It's just complete record high. Let's take a look at cumulative withdrawn and expired. We just beat out 2011 on the cumulative withdrawn and expired. And on the cumulative sold, we're at 14,000. So we got close to 30,000 new listings. Then you've got less pending. And of course, then you have a little bit less sold. So all this information is updated, available on the website. Please take a look at it. Let's take a look at active residential inventory and make sure that you know exactly what's happening with the market so that you can start the week well, start the week equipping your clients. We've got 13 minutes left in this call, and we will hit it hard. Do we believe that the equity will continue to fall on properties that have been purchased before the 2022 for people that own are losing equity as time passes? As the market goes down, everyone's equity will drop. The degree in which their equity drops in relation to their original investment is based on when they purchased. If they purchased anything, and these are macro numbers, there are areas that have outperformed other areas. Out of the 30 municipalities that we track, 17 have gone down. 11 have gone up, and then 1 Gerald remained the same. So there are municipalities that have actually gone up in price year over year. There are always going to be recession proof. So looking at the market is really like peeling an onion. What's happening within our entire MSA? What's happening within our county? Williamson County is going to be different than Travis County, than Hayes County, than Bastrop. And then what's happening within our municipality in the context of that county? And then what about our zip code? And then what about our subdivision? And then what about our street? And what about our property? So you always have to drill down to see how does it affect that individual unique property. But we can look at the macroeconomics and we can say that people that bought their house from 2021 to 2023 in Austin, that 30% are underwater. 30% have no equity. Like their equity has been completely evaporated. We can pull those numbers. Like we can see, okay, I know you bought this house for $500,000 and I know that it's worth $350,000. You have no equity. Like you're done. It's going to take you years, if not a decade, to return back to where you would be able to sell without losing paper money. For some people, they're losing real money. So that's the reality. Now, if they purchased before 2022, well, when? Right? I purchased my property 2017. Well, I'm still on the plus side, way on the plus side. If you take a look at the median price, and I can go to Insight and Statistics, and we can take a look at market cycle. Let's make this a little bit bigger so that you can see it. I'm going to go ahead and download it so it can fill the entire screen. And we're going to be reviewing this anyway, so this is a perfect question at the perfect time. Take a look at the average price. So this is the line. Anyone who purchased here, and you could even draw that line a little bit lower, they're underwater. But if you purchased your home here, you're good. Some properties have lost value, but at the macro level, you're good because of this nonsense that happened. So does that answer your question? The big question that everyone asks, how low can we go? Right? It's like that wedding song. How low can we go? That's the question that everyone wants to know. Everyone wants to time the market. I like to look at fundamentals. Like what makes sense? What doesn't make sense? I'm a mean regression theorist that certain ratios regress back to their mean. I look at the median sold property to income ratio. That's a ratio I've looked at for 15 years. And we still have a ways to go when you look at the median sold price to income ratio. In order to get back to a historical ratio, we've got another 10 to 12% correction. Now, real estate markets do tend to overcorrect. The FOMO effect goes both ways. So, could we experience another 10 to 15% price drop? Absolutely. All day long we could. Well, over how long of a period of time? 18 to 24 months. Or, you got Chairman Powell's term is over here fairly soon. What happens if we get a new Fed chair that, heck, if I know what they're going to do, what if they lower rates to 0.5%? What if they start buying mortgage-backed securities, which I would be utterly opposed to? I wouldn't want that. But what if that happens? Oh, man. 40% of the price appreciation over the past 20 years had nothing to do with the value of real estate or the demand for real estate. It was artificially manipulated lower rates by both parties. Right? So what if that happens again? Well, then prices will go up. So there are external factors that could very well tweak fundamentals, and they try to tweak the economic dial and not allow market conditions to work themselves out. And that could very well happen. And then whatever fundamental guesses that we would have are just gone. You just go with the flow. You just ride the wave, which is what we've been doing. So very good question. Let's take a look at the number of listings. We've got 18,149 active listings. Do you think that's a record? Record high. The city of Austin has never, ever, the Austin area in its history had not only more than 18,000 listings, well, we had it on Friday, but we've never had 18,146 active listings. That's an increase of 70 daily, 209 weekly, 852 monthly. That's a 4.93% month-over-month increase, reversing a trend that we saw back in the first part of June. So we are now seeing more year over year as a percentage than we did in June. And take a look at the pending. Oh, I double counted this to make sure I wasn't wrong. 4,443 pendings. Y'all. See that activity index? Do you notice something interesting about it? What do you notice on that activity index? Under 20%. Under 20%. 19.7%. And you notice something on the months of inventory? 6.51%. We are very close to a buyer's market. We've got a record high number of active listings, up 19.4. Yeah, that's the lowest in a very long time. In a very, 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 very long time. Absolutely. We do have a few other resources where we track the activity index at the macro level. If you go to Insight and Statistics, you go to residential inventory and even market performance. Here's market performance. Here's the activity index, and you can look at the activity index going, let me go ahead and just do a little refresh. You can look at the activity index going all the way back to 2010. We did have lower activity index back in 2010, and this shows 21% because we don't have June yet. This graph I only update once a month. It's got a new date on it, but I only update it once a month because it looks at all the percentage increases over time. But it's the lowest activity index that we've had going all the way back to 2011. It's not the lowest one ever. The lowest one ever is reserved for November of 2008, right after the Lehman Brothers collapse. That was bad. That was just downright awful. But it is still very low. And on a historical context, it's the lowest one in 14, 15 years. The interesting thing is that we are now at 16.71% activity index on resale, 28.13 on new construction. So a lot of pressure on resale. And take a look at this number, you all. 53 short sales. Wasn't that long ago. We were looking in the teens. 53. We just hit 6.51 months of inventory. Oh, that line is so low. I need to change where my 20% starts. I used to have this as a 20% lowest. I need to change that to like 10%. Pending listings, we're down 5.6. And here's the activity. I've got to change that. I've got to change my charts. I've got to lower the percentage number on my charts. What a pain. Months of inventory, take a look at that. That sucker just shot up. We're at 6.51. We were at 5.4. We are 70 listings higher than we were on Friday. The last year we reached peak value July 15th. We're June 30th. Last year peak value was 15,503. We're at 18,146. Insane. Crazy. Out of all of the active listings currently in the market, 56.8% of those have had a price drop. Give me 3 more minutes and then we're going to call it a day. Let's take a look at the bond market. Let me turn around. What are we at? Is there any good news? Oh, yeah, we're down 2.1 basis points. There's your good news for the day. Bond market down 2.1 basis points. We've had a really decent, a fantastic rally over the past 7 days on the bond market. So I've enjoyed looking at Robert's rate sheet. Let me pull up his rate sheet right now because he is quoting team price at 6.625. And we've got 6 1/8 on FHA, VA, USDA. Man, I'll take that. I'll take that all day long. When you take a look at the sold information, median sold price went negative last month, but we're still positive across the board this month. Let's look at a few things. We're still down 12.86 on the average. We're down 18.18 on the median, down 100,000. And I just want to show you this one right here. If today is the bottom of the market and the market appreciates back using its compound appreciation rate, 25-year compound appreciation rate, slightly under 5%, we're looking at a recovery back to peak value September of 2029. The last thing that I want to share with you is going to be the percentile analysis, the high-low, so that we can see which brackets are going up. And take a look at that. You just can't make this stuff up, y'all. My goodness. Even though closings are down 24.3%, the bottom 25th percentile is down 3.84.7. Top 25th percentile up 2% on price. Complete reversal from 2 weeks ago. 2 weeks ago, and that's why prices are up. So we just had another bump on the top 25th percentile. The top 25th percentile is far outperforming the bottom 25th percentile, which is why we are up on the average price and the median price. That is why we are up. The very last thing that we're going to cover is going to be the economic forecast. We've got Chicago PMI, worse than expected. But this week we do have July 4th on Friday, so nothing's going to happen Friday. Fed Chair Powell speaks. That's going to be big. We've got job opening, labor turnover. We've got economic optimism. We've got payroll information. We've got a lot of stuff that's going to be reported this week. And commodity on Friday. Nothing else on Friday other than some commodity information. So super important week this week for the bond market. The biggest one is going to be on the Fed Chair Powell speaking tomorrow morning at 0830 hours. And some reports related to job openings, labor turnover, economic optimism. But so far we've had a really good run in the bond market. Let's hope that that continues. It is 11 o'clock. If you do not have any questions, comments, concerns, criticisms, complaints, thank you so very much for joining. Super appreciate it. Do not forget to do your contract proficiency, which is due on Wednesday. Do not forget to do that. We will have a Zoom meeting, training, broker Q&A on Wednesday. And of course, July 4th is Friday, no Friday meeting. And we've got another question. Does this sound about right? Top 25th percentile purchases means that millionaires are moving in and spending more on residential property. Are they following Musk? Well, they're not moving in. Actually, Austin has actually lost like millionaires and billionaires. Like they've lost that kind of population group versus gaining. So what I would say is we know statistically that the upper end is outperforming the lower end, and that real estate is being used as a store of value, as a long-term store of value. We also know that the Austin area has had a pretty decent raise in bespoke properties, custom homes, really nice assets that are now used as a secondary, third, or purely as a store of value. And that's a segment of the Austin market that we haven't had in the past 20 years that we do now have, whether it's within Lake Austin or other parts of 78746. So we do know that that's happening, and that will continue to happen. Very attractive city, very good location within the country. You've got easy access to flying in and out. But at the same time, the data doesn't show that we're having like this explosion of millionaires and billionaires moving into Austin. That happened for a short period of time, but that has been stalled at best and actually inversed at worst. And the data shows that. Some articles were published on that. But doesn't change the fact that the 25th percentile is clearly outperforming the bottom 25th percentile. As far as moving the Friday meeting to Wednesday, that's not going to happen this week. So I'm still working with the Austin Board of Realtors in order to see what their availability is. I will have an update to you all by the end of the week, beginning of next week. I'll have an update so that you all know exactly what's happening if we're going to have our in-person meeting on Wednesday. It's really a matter of confirming with ABOR. I'd say it's not a matter of if, like we are doing that. It really works better for everyone. I got really good feedback from everyone that moving that team meeting to Wednesday works out way better for everyone. So I'm excited about that. Works better for the entire team. So it's really not a matter of if, but it's a matter of like, yeah, let's just go ahead and finalize it with ABOR. ABOR reserves those rooms like months in advance. So it's just a matter of working with them on rearranging things. That's the biggest holdup and challenge right now. But otherwise, you all, thank you all so much for joining. Super appreciate it. If you have any questions, comments, concerns, criticisms, or complaints, please let me know. Here to help. Otherwise, please join us over Zoom on Wednesday for broker Q&A, contract review, some really good real estate training, and I will chat with you all later on. It's good to be back, and I will see you later on.